Many times, a reverse mortgage line of credit is also considered alongside a home equity line of credit or a HELOC. If you're considering one or both options, you've landed in the right place, as today we're comparing both options in this video. So stick around to find out which option may be best for you. Hey guys, Taryn Proctor once again coming to you from Retirement Home Equity Advisors with another educational video about reverse mortgages. Oftentimes, when I get clients who call in inquiring about a reverse mortgage, the natural comparison to a home equity line of credit gets brought up. So today, we'll be discussing the features of both as to give you a better idea on which option may be better suited for you. But first, if you enjoy this video and learned something today, go ahead and give it a thumbs up and then click that subscribe button in the bottom corner somewhere, along with the notification bell. So you're notified when I put out our reverse mortgage education videos every week. Now, a reverse mortgage line of credit or a HELOC, which is better? Well, that really depends on your long-term goals. So let's start first with what is similar about these two options. First, they're both actually loans against the equity you have in your home. And second, neither of these options charge you interest on the money you have left in the credit line or the money you haven't used yet. And they don't begin to charge you interest until you withdraw a sum of money out of them, similar to a credit card. And lastly, both of these credit lines are revolving. This means that you can borrow, then pay back, then re-borrow the money you paid back with each of these accounts. There are some differences with how each of these credit lines work, though, with regard to the revolving nature and payments. So we'll go over that in a bit. And this brings us to the biggest difference between these two options, which are the payments or lack thereof. Because with a HELOC, any money borrowed from that credit line will also come with a forced payment. Generally, a HELOC will force you to at least pay interest-only payments for a period of time. And then after a certain time frame, usually about 5 or 10 years, those forced payments become principal and interest payments, making them larger. That may not be suitable for your long-term goals. Whereas with a reverse mortgage line of credit, any money borrowed does not require payments, but those payments are optional if you'd like to make them, giving you much more flexibility. Because with a reverse mortgage, you can pay what you'd like, when you'd like, or not at all. Next, if you remember before when we were discussing the similarities of these two products, I mentioned that the revolving nature and payments of each of these credit lines works a bit differently. Well, the reason for the difference is because with a HELOC, as I mentioned previously, initially you will only have interest-only payments. Now, if you choose to only make that minimum interest-only payment, none of that payment will go back into your credit line for you to re-borrow in the future. It is only if you choose to make more than the interest-only payment and actually begin to pay down the actual principal balance that the principal payment will then lower the balance and increase that line of credit again. Whereas with a reverse mortgage, dollar for dollar, what you choose to pay goes back into the credit line for you to re-borrow in the future. You are not limited with a reverse mortgage to only having the principal payment put back into the credit line. This is actually really helpful, especially for the third big difference between these two products, which is growth. Now, with a HELOC, you initially qualify for a certain amount, and that is it. That's that. There is no more. But potentially, there could be less in the future. And we'll get into the less part in a second. But as far as a reverse mortgage line of credit goes, any money you have in that credit line will actually begin to grow. And it will grow at the same rate that you are charged for interest plus another 0.5%. Major advantage of the reverse credit line. Now, last but certainly not least, this is a big deal as far as long-term sustainability goes. As I mentioned a second ago, a HELOC could potentially be less over time. And that's because a HELOC, it can be canceled, frozen, or reduced at the lender's discretion. We saw a lot of this back in the 2008 crash and are beginning to actually see some instances right now because of market volatility. But with a reverse mortgage line of credit, this credit line is guaranteed to you because of the federal insurance. That is to say that as long as your loan is in good standing, meaning you're continuing to live in the home as your primary residence and you're keeping up with your property taxes, homeowners insurance, and other property charge payments, your reverse mortgage credit line, along with the growth of the credit line, cannot be canceled, frozen, or reduced for any reason. This is a great long-term protection against home value depreciation and just ensures that you have access to a growing amount of funds for when you need it. Ultimately, in my opinion, guys, the reverse mortgage credit line has many more advantageous long-term benefits over a HELOC. But a HELOC may be a better option for short-term necessity, as long as you'll be comfortable with the payment that comes along with it. Again, this all boils down to long-term goals and what you're wanting to use either of these options for. And I cannot stress enough that when evaluating these two options, please, please truly think through the long-term ramifications and truly play the tape all the way out. Because I've had many phone calls over the years from folks that are panicked because their HELOC payment is about to fully amortize, meaning their payment will no longer be interest only and will be requiring principal payments as well soon. And they're desperately trying to at that point pay off the HELOC that usually along with another mortgage, they're trying to pay these things off with a reverse mortgage at that point. And this is because the fully amortized payment they'll soon be required to make will be really tough for them to accommodate for financially. And many times, because of the HELOC balance, they don't qualify for the reverse mortgage. So please just make sure to really think that through. And if you'd like to learn more about the reverse mortgage credit line and your reverse mortgage options in general, then definitely give me a call. I'm always happy to run through your options with you so that you are better positioned to determine if a reverse mortgage would be a good fit for you or not. You can reach me at 888-982-0475. Take care.